Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm excited today to be here with David Reed of Reed Jolly, the law firm. David, how you doing today?
I'm doing great, Mark. It's a pleasure for being here. Thanks for having me.
You got it. Yeah, and you're on my mailing list and we follow each other on LinkedIn and I shoot a lot of different things out in both directions and we had a good little dialogue going on the other day about loan quality and it triggered, hey, let's get you on the podcast. And I first met you back when you helped NCUA with some strategic planning under the Matts administration. I think that was
Right.
back when Dave Marquis was executive director and I was regional director. And that's when I got to know you and all that and enjoyed that back then and have enjoyed following you since. But so a lot of my listeners may know who you are, some of them may not. If you could maybe give me a little bit of your background, that would be great.
Absolutely. I hope nobody holds this against me, but I'm an attorney by trade, but I always introduce myself as a recovering general counsel. I entered the credit union world by working with credit union here. I've been practicing for probably about 10 years, and I was hired here in Northern Virginia. And my initial job title, which fits well into what we're talking about today, was in-house counsel slash collections manager. And I had been at a firm in DC. I had been doing a lot of civil litigation, a lot of different collection stuff at the state and federal level. Our twins at the time, they're pushing 30 now. At the time, they were probably 3 years old or so. And the DC world of law just is not a good place if you're working in DC with a family in the outskirts of Virginia. So I looked for an in-house gig and I went in with the credit union. Give a shout out to Apple Federal Credit Union in Fairfax, Virginia. Great credit union. And Larry Kelly, the CEO, hired me because they were having issues in their collections department. And I sometimes joke that they said they were having a fire in their collections department, but I think that's because they fired the prior manager. They were looking as they were growing to bring on an attorney anyway, but this was a great doorway to do it. And I started with the promise that, hey, as you learn the business, because I had never worked in or around a financial institution, as you learn the business, your responsibilities will grow. So for the first probably 18 months, I was a frontline manager. I wasn't a director. I wasn't in the C-suite. I was the collections manager. So I learned the credit union world from the collections department. And as I began to put processes into place, work on some training, change some key personnel, I then was able to hire a collections manager. I became general counsel. A couple of years later, I became VP and general counsel as part of the senior executive team. And then I think probably a year or so before we met, I left. Very friendly parting of ways. We work with Apple still now. And I formed my own little entity, and that's Reed and Jolly. And I exclusively work with credit unions all across the country. I've also had the blessing of being a credit union volunteer for about a decade. I was a member of a supervisory committee of another federally chartered credit union, served the last 6 years as chairman of the supervisory committee. So I am seeing this marketplace, the cooperative financial services marketplace, from a lot of different angles. But the one commonality that I've had throughout is an appreciation of loan quality and the role that the collections plays, not only within the credit union operations, but also, let's face it, the A of camels is asset quality, right? It's a very important concept, and the spotlight's getting shown on that again.
It sure is. And yeah, that's what kind of triggered our conversation. By the way, another shout out to Apple Federal Credit Union. They have a wonderful first responders, first time homebuyers program that my daughter and her husband were able to participate in.
Oh, wonderful! That's great.
Yeah.
Yeah, they have always been, I think, on the cutting edge of,
Yeah. Yeah.
community based financial services.
You got it. You got it. But yeah, so the recent NCUA letter to credit unions came out, and I always do a podcast on that. It was always, since I left NCUA, it's the one communication from NCUA that I look forward to most every year. And this year, I don't know, it was 22, 23% of the verbiage in that letter. The highest percentage of any topic that I can ever recall was specifically devoted to loan quality and asset quality and
It was
credit credit risk, right? So they're really focusing in on that, and I want to praise them. Sometimes I beat them up. I've changed teams. I beat them up when I think they need to be
Graduated.
Yeah, I graduated. Yeah. And I praise them when I think praise is due. And there was a year a couple of years back where they had 12 priorities. And as I like to say, if everything's a priority, nothing's a priority.
That's exactly. If we focus on everything,
Yeah.
if we're going to be number one at everything,
Definitely. So they've honed it in. They've got it down to 4 or 5 priorities, and they devoted a lot of time to asset quality. And that's because delinquency trends are up. Ironically, if you look at the numbers today, back to 15, 20 years ago, what we thought was high delinquency today is different than what we thought was high delinquency
oh my goodness,
in the day, right? And
right.
those are creating some pressures for credit unions, and you do and so you've seen some things with your clients, with your discussions. I know you do training as well. I've seen you doing with some photos of you, I think, standing on one leg doing
Balance. Yeah, there you go.
yeah. And anyway, so that balancing act of collecting the loan, making the loans and all that, talk about what it is that you're seeing out there with your clients or your credit union discussions on loan quality, delinquency, collections, et cetera.
Absolutely. First of all, just echo everything you just said. I am always pleased when the NCUA pulls back the curtain, which they do with the supervisory priorities, and say, hey, from our perspective, which let's face it, is a pretty good perspective. This is what we're seeing. And I believe this is the second consecutive year that credit risk is up there, but it's the first time with a rocket, not that we put too much emphasis on what order it's in, but like you said, the vast majority, certainly the plurality of that letter was focused on credit risk. And it's a concern to a great many of our clients out there. I'm very blessed to be able to practice with a great credit union attorney, Bruce Jolly, and we have clients all across the country. And I have been doing an increasing amount of work going back to the delinquency control, collections, portfolio management, risk management, which is the label that everything is going on now. And when you read the language of the NCUA letter 25 CU01, first one out of the box, but they talk about the delinquency, particularly in credit cards and used car loans. And they harken back on credit cards to make their point. They said it's the highest level since 2010. And just as a quick side note, the world shifted on collections in 2010, right? So when I first started in the 90s in the credit union world, and like I said, I left at 07. So I left just right before the world collapsed, mortgage-backed securities and all that. But if you would have asked me, probably even as I was out the door, if you would have asked me, is there any way that real estate could dominate delinquencies, either by numbers or a percentage, or be the major concern from either an operational perspective or from a regulatory perspective, I would have said, of course not. Of course not. I can remember as we were shifting through different allowance for loan lease loss methodologies, arguing for greater reserves for a growing real estate portfolio. And I can remember arguing with the examiners, talking about the irony. They're like, no, you're reserving too much. I'm like, listen, we're growing 30% portfolio every year. They're like, yeah, but historical loss perspective and all the things. Then what happened? Boom, the Big Short happened. And that changed everything. And that kind of started a different focus on collections with the modification policies, don't extend and pretend. But I only say that, I focused on that because from my perspective, it's as if that's the last time that anybody really focused on collections. They talk about it, but it's like smiling and nodding and looking at the key performance ratios. But as far as training and staffing and technology and process, there hasn't been a lot of work put into that by a great many credit unions. The second thing that they mentioned in the supervisory priorities was in used cars. And they made a special point, and you know how it is when the supervisory priorities or any letters to credit unions are created. This thing went through 12 drafts, 14 different subcommittees read it. But they made a special point that said, if you look at the delinquency by portfolio, which is important. So a lot of people say, oh, our overall percentage is this. Okay, what is it in credit card, in used cars, in home equity lines of credit? And we'll probably talk about that in a few minutes. But it's the highest delinquency and charge-off ever in used car loans, ever. So what I'm seeing out there is, I'm not going to be overly dramatic like the NCUA sometimes, but it is a little bit of the perfect storm, right? Credit cards, used car loans, if you have economic instability, I don't know, let's pick high inflation, right? Things like that. These are two areas where people of, dare I say, modest means, they focus a lot of their borrowing. And credit cards help them cover what they're doing. And what I'm seeing is that many credit unions are getting caught flat footed with the rising tide of delinquency. And as they go to address it, they're addressing it with processes and technology or the lack thereof, like they were doing 10 or 15 years ago. And the market has passed them on that. So I work with a lot of different credit unions on basically just digging out all of the layers and looking at what the core mission is of the credit union, which is to serve the membership, the white hat of the financial services sector, right? We're owned by the borrower, which is different. And then look and see better ways, especially to utilize analytics and technology. If I had to say what I'm seeing missing out there, it's the leveraging of analytics that are probably being used within other areas of the credit union and leveraging technologies that are being used by other parts of the credit union. The ability to text, the ability to engage a borrower in a chat if they get on your bill payment system, if they get on your mobile app or whatever, technologies that are being used by marketing and lending for other areas, but not being used in collections. So
Sure.
there's a retooling.
You don't reach your member by leaving it on their home phone anymore on the answering machine. Hey, it's the credit union, we'd like to call you. And you've got the things you can say, the things you can't say. But I hadn't thought about
Very important. Very important that I talk to you.
yeah. I hadn't thought about the text on a loan saying, hey, I haven't got or you need to reach out about your car loan or whatever. But yeah, I mean that makes a lot of sense. So you talk about the inflation, the perfect storm, and there's a I think it's the Used Car Guy podcast. It's a guy who's on LinkedIn, but I
Yeah.
followed him a little bit, and more so during the pandemic when he'd say used Corollas are going for $40,000 or whatever. And okay, this can't end well, right? So then you get into okay, this is the aftermath of cars being expensive, of inflation being inflation, and then people right, life happens, right? People get divorced, people pass away, that their financial condition changes, and we're seeing a little bit of that kind of bubble up into some of this data, and at the same time, then you've got the attack on fees, the nomenclature, junk fees, overdraft. It get every year to be pick a number. Every year, it's harder to be $100 million credit. It's harder to be a 300. It's harder to be a $1 billion credit union because there's more
Right.
competition and you're getting nibbled away everywhere.
From outside and from inside. Yeah.
Right. That's right. Yeah, that's right. They're coming from inside the house.
We met the enemy and they are us, right? So
And then here we are with the other thing when you're talking about going back to the stat 08, 09 to 2010. Back then it was a lot of the delinquency it was in one of the states where I'm at, the sand states. You had
now there's a blast from the past.
Florida,
The
the
states.
sand states, the states where it was, and so you had the haves and have-nots with real estate delinquency. And I'm not seeing that right now anywhere, but have you seen anything where there's pockets of maybe California with the fires? We're going to see some issues there.
Oh, yeah, just the natural disaster aspect that will play its way through. NCUA, again, to their credit, immediately has stepped in with central liquidity funding and other flexibility for those credit unions. Now, it is, I guess I would say a couple of things. The core message is this is the time to prepare. You need to look at your internal processes. You need to refigure those. You need to give some amount of extra emphasis on collections as opposed to collections always being at the end of the parade, getting the old computers. And when all the highlights come out of new software or new upgrades in core processing, there's always stuff for marketing and lending and ID and security and cards, nothing ever for collections. And we need to flip that a little bit. But it is nowhere like where we were in 09 or 10, which is good. People talk about, is there a bubble coming up? And that's always important for us to think about. But there's so many tools in place now for shock testing and concentration testing and all of that.
Yeah, I agree. I agree. The agency's in a better position as far as the training that they've given their staff, expectations on ALM, shocking the portfolio, the NEV test. The industry at NCUA has collectively raised the bar with that.
Right.
I would agree on that. Hey, one thing I've talked about a lot, and I've seen in my credit union conversations when someone is dealing with NCUA relative to their exam, is we're seeing a lot corporate governance being raised. As you get an exam report, you got last year you were a 2, this year a 3, last year you were a 1, this year you're a 2, but you have document resolutions and examiner findings. They tend to be linking those back to corporate governance from what I'm seeing. Have you experienced any of that in your conversations with?
Oh my gosh, absolutely. So I do a lot. A great amount of my time is spent in the training area, and I had the opportunity to host the MC, the Supervisory Committee and Internal Audit Conference, the big one this year. And corporate governance is front and center. It has been for a long time, right? The general direction and control of a credit union is handled by the board of directors. Examination teams have always looked at board minutes to a certain extent, but as the financial services, the cooperative financial services marketplace continues to evolve and become more complex, I think there's an enhanced approach to make sure that it's not just the management team that's keeping up with what's going on in the world, right? One of the things that we're seeing in collections is sometimes what I think examiners have seen in the boardroom, which is this is always the way we've done it. Let's face it, the reason that 701.4 came out, I can remember somebody telling me that the concern amongst examiners, amongst the NCUA, was that the major exercise of board power, and then this, of course, in the aftermath of the real estate collapse, because I think 701.4 came out in either '07 or '08. They were the same time period, but they said that the big exercise of board governance was double thumbs up, and that's not a right. 10-day operations are handled by management, but the risk appetite and a general understanding of where the credit union is going has to be handled by the board. So I'm seeing a lot more emphasis in that. And part of it is that you see that struggle in our outside role as outside general counsel to credit unions all over the place. We've seen that struggle with a board that is well overactive, and sometimes a board that's like an absentee landlord. Oh, hey, if you think that's right, that's fine. What's for dessert? So there's a lot more emphasis on that. But really, I tell people, again, take a deep breath on governance. What they're talking about is all the machinery that runs the credit union. How does the board operate? When you look at compliance management system, it starts with the board and the senior management team. What's the level of communication? Does the board understand what's going on? And yeah, we're seeing that more and more. Being able to show that the board is receiving information, something more than just a line item on the CFO's report, that they understand what's going on in the portfolio, what efforts are being made. If I was speaking to a collections exclusive group, I would always say, collections is not about delinquency and charge-off. That is a measurement of the health of the loan portfolio. Right. We're about making contact with the members and working through a pretty simple formula. Right. And that formula is what's going on with the member, married up to what tools the credit union has. And that gives us the best chance of success. So we want to share success stories with the board as well. But going back to what you're saying, I've worked with a number of credit unions. They'll give me a call, and the board chair will say, yeah, the examiner in charge made a comment that our delinquencies have been going up every month for the last 6 months. And they were very disappointed that there was no discussion recorded in the board minutes about loan quality and about collection efforts and things like that, that everything was about new business lines and new technology. And they asked me what I thought about collections. And I said, I don't think about collections, which guess what? That's the wrong man.
Yeah, there's a definite what's in the board minutes, what's missing from the board minutes. Are there trends? Another board minute is we haven't talked about possibly wanting to merge another credit union into ours in our strategic plan for 1, 2, 3, 4, 5 years. And then this year we're applying to merge 3 credit unions in because the opportunity came up. And once we made push to say, hey, this didn't seem to be like it was part of your plan. Suddenly it's all your plan. How does that make sense with the risk appetite and everything else? Yeah, there's definitely a lot of focus on those type of things. Hey, one thing you said too about providing outside OGC assistance to credit unions. A buzzword out there, and I think probably attorneys were way ahead of the game on this as far as how they operate in that environment. But the fractional CFO, the fractional
Oh,
that the word fractional and services is out there in the world, and it's starting to pick up in credit unions. But really, the OGs having an outside general counsel has been a fractional service forever. Have there been any changes, any thoughts relative to that? Just that statement, the fraction.
so first of all, you're absolutely right with the fractional, and I get that. I used to love to work with the Office of Small Credit Unions and things like that and talk about how they could build up economies of scale with 3 or 4 credit unions, let's say below $50 million, and they would go out and they would hire an IT person or things like that. And that makes sense. But if you're a larger, more complex credit union and you're fractionalizing this or that, it can become a bit problematic. Fortunately, in the legal services, we are, I hope I'm not going to get too much feedback, negative feedback on but we're a commodity.
Right.
So you can use us on a cafeteria plan a lot easier than you can use IT or CFO. And I'm not arguing against fractional. Again, I think that has a role. But if somebody is, classic example, right? Marijuana related businesses, to the extent that I'm ever on travel, and let's say you're sitting someplace, having a cool, refreshing beverage, having your Caesar salad, and the weary traveler next to you asks what it is that you do. If I am going to engage in, my 2 responses are, number 1, I'm a Chippendales dancer.
Right. Exactly. And you can pull that off.
They look at me and they usually have a little bit of a confused look and I go, I'm on disability. The other thing that I say that always will either get them laughing or in the conversation, I said, oh, I help clients bank marijuana money. But that concept, if somebody's interested in doing that, I can't even count the number of executive teams or boards that bring me in and said, okay, let's just talk about this. Tell us about risk. Tell us about what you're seeing. Tell us about what we need to think about. Once that project is done, they're yay or nay. Now I can just be used as needed and I go away. So I think we were a little ahead of the game of that. What's interesting on that note, that when the NCUA, when you read, and again, I want to say it's 4 paragraphs, but like you say, it's a quarter of what they wrote. And as they always do, the whole purpose of the supervisory priorities is, hey, we think these are risks to credit unions.
Yes.
So we're telling all of our people, boots on the ground, we're saying, hey, this is a risk. And I jokingly say this if I'm teaching compliance or if I'm teaching governors or whatever. I said, all right, if your examination team has been told this is an area of risk, do you think that they're going to make an administrative record of those items?
That pretty good chance that some of your conversation or material amount of your conversation is on asset quality, is on credit risk.
You better be prepared.
You better,
because they're giving you a guidebook, but they talk about, of the things that they're going to look at, they talk about loan underwriting, they talk about risk management, allowance for loan and lease loss. And I always jokingly tell people, I said, I'm not worried about anybody's modification policy ever, because you have one, because they've been looking at it for 15 years. And everybody has the same challenges as far as when CECL came to town and all of that. But they also make sure that they talk about 2 other things: third-party risk, right? Because collections is filled with third parties, right? Collection agencies, collection law firms, repossession companies, people that they use for foreclosure, skip tracers, all of that. But then they also, again, within credit risk, made a special shout out to board reporting, right? So anytime you see board reporting, that's governance, right?
That's governance.
What is your board thinking about that now? And it's okay if the board says, hey, this is a trend, right? We talked about financial literacy, and when that came out, it was really the big impact of 701.4 in the NCUA rules and regulations, was that paragraph 3 on having a general working understanding of accounting and finance. But it's not only what the number is right now, it's what the trends are. And so it's okay for them to go to management and say, all right, what are you doing about this? That's not what management says, oh, don't worry about it.
Yeah, I didn't pick up that board reporting reference. That's very powerful words. Because one of the things that my team and I did a podcast on the letter, and we talked about the fact that we were anticipating at some juncture corporate governance in and of itself will be a topic in one of these letters, particularly because that's what we'd be seeing. But that's a hat tip to it, the board reporting. So if your delinquency has gotten if your collection program is problematic and that's having financial impact, you can bet your bottom dollar they'll be, if they don't like what they're seeing, the chances of there being a document resolution on corporate governance has gone up because of that. So that's an excellent point. You made one other point about the third party, the reference to the third party. It gives me a good opportunity to cross sell my other podcast, which is Credit Union Regulatory Guidance, which is an audiobook styled AI built program where I go through NCUAs or OCCs or CFPBs, whoever, any guidance that I think credit unions might like to listen to. I put it in the audiobook style, and I just redid the third party letter. I think it came out today or yesterday, the day we're recording this, where you can listen to the full guidance NCUA has on third parties. And there's a lot of good information there. It's an older letter, but those core principles remain the same. And there's also, by the way, if you're looking to beef up your third party due diligence, there's really good guidance from FDIC out there. While it doesn't rely on that, it's very exhaustive. And I guarantee you, if you read through the third party due diligence and the governance that FDIC requires, if you go through that and go, yeah, our program looks really good, you're gonna pass your exam with flying colors.
Well, without a doubt. And first of all, I love that because, like you, I'm a true practitioner of this, right? Which means I'm a little bit of a geek.
Right.
You have to look at what's going on. And I just did a webinar for the Credit Union Webinar Network. Shout out to that. And it was on the compliance outlook, what's coming up. And of course, it talks about elections have consequences and all of that. But the week before I did it, supervisory priorities came out.
Right.
Travis Hill at FDIC gives his bombshell statement on Friday, and it says a new direction at FDIC. OCC had already put out in the fall their compliance outlook for fiscal year 2025. And of course, FDIC has a great publication. What's it called? Risk Review, I think, which is a really good market. And then, of course, Federal Reserve has their compliance outlook and things like that. And we need to look at all of that. And guess what? I hope everybody's buckled in, but credit risk is being touted at OCC, at FDIC. And let's remind her, OCC, national banks, FDIC works with the state on non-Federal Reserve member community banks, and then Federal Reserve works hand in hand with the state on community banks that are also members of the Federal Reserve System. And this is a marketplace trend because it's an economy trend. The deal is, and where I have been spending a lot of my time, literally over the last year or so, is that there are unfortunately a lot of credit unions that they are operating with, this is always the way we've done. And guess what? If old school collections has two moving parts, that's it, just two. And it's the ability to pay and the willingness to pay. And you need them both, right? You need them both. And we can actually help with both, right? Willingness in that you want to be a member of the credit union, use the products and service. Ability in this, that the reason I think a lot of people don't speak to the credit union about delinquency is the same reason they don't speak to anybody about delinquency. They don't like the fact that they are delinquent. And number two, they fully expect that the person's going to say, I want every last dime that's due right now.
Yeah.
And I just bought groceries a little while ago, which shout out to my wife, Diane Reed of CU Doctor, for putting the trust in me to send me out to a grocery store. But when you're paying close to $7 for a dozen eggs, that's an issue. Apartment prices keep going up. Home ownership is an increasingly distant dream for a lot of people. And there's this concept out there called financial wellness. And financial wellness goes beyond, I'm current on everything right now. Financial wellness is, can I plan for the future? Right. Am I comfortable where I am? And going back to what you said, one of the things we've always dealt with, but I think we're dealing with more now, is that concept of our members hitting an unexpected storm, an unexpected expense. A child gets divorced, loses work, has to come back in. A parent has to come back in. Loss of overtime, a change in administrations, and suddenly whole departments are being laid off. And credit unions know this when they think about it, right? If you look at your average member, look at everybody, look at all 100,000 accounts. What does that average account look like over the course of a month? And for most credit unions, the average is many, so or the median, more above and below, but I think average is probably better for this. But people get paid and their account goes down to zero, or in many cases below zero.
Sure.
And then it comes back up. And what's in their savings? $400 or $500. Guess what? $400 or $500 isn't going to pay to get an arm reset that's broken. It's
Sure.
not going to pay for a new transmission. It's not going to pay if your hot water heater blows up.
Yeah. And those are the things. Every time I go to the store or buy something on Amazon and I look at the prices, you get numb to it a little bit. But when you realize you used to pay $2 for eggs, then you think about how blessed you are that you're able to do it.
And that's the worm.
But the flip side of that is, how do people do it? And if and if I'm thinking, how do people do it? Being in that pressure cooker of having to do that, of having to make that car loan, needing that car to get to work, all those things. And those are difficult conversations, and you want to approach them with care, but you want to have those conversations so you can educate them to do the best while mitigating the loss to the credit union. It's a delicate balancing act.
And again, and that's one of the reasons that I do. This big, fat, balding guy balances on one leg.
Right.
Because we do want to make loans. We do want to grow. We do want to acquire new members. I make reference to this all the time. The book that I read every day, it's got a lot of great stuff in it. But one of the things it says is it's easy to love somebody that loves you. Even bad people can do that. The hard part is to love somebody that hates you. And what does that have to do with credit unions? It's easy to love an 820 that comes in and wants to buy that late life Harley Davidson. And now we can cross-sell them on an RV loan. We can cross-sell them on a $50,000 Visa. But what do we do with the person that comes back in second time in a year? They have a 580 credit, and they want to get another modification of that loan.
Right.
Because if it comes down between being able to pay for their kids' after-school program or making that next payment on the credit card, we know who's going to win.
Sure. Sure. Right.
And so it is, we have to be proactive. So yeah, we have to educate. We have to let everybody know, again, that we're in the solution business. That's why I've been literally preaching for 20 plus years. I'm reasonably certain I'm the person that came up with the phrase member solutions, as opposed to the collections department. Collections, you're not going to get many people to come to your pizza party
Right.
if you're the collections department, but member solutions. And look at those analytics that we're using to make pre-approved offers of credit, to market to new areas. I was getting ready to hold my text phone, although we're in audio, my telephone. But if I get a text message from my credit union saying fraud alert, I look at it.
Sure.
If I get a text message from another one of my, I'll say trusted vendors, I take a look at that. And if the collections team is not being proactive, if they're not utilizing analytics that they already have, all the data points they have, especially if they're primary financial institution, to whatever that means in the days of neobank and nearbanks. But if we're not using all of that to try to be proactive, then people wake up one day and they're not able to pay and they go silent. And that's the biggest thing. Are the people that go hardcore delinquency, especially on credit cards and used cars and things like that, really on anything, they just don't know what to do next.
Right.
They don't know who to trust. And there's a lot of people out there shouting at them, right? Pawn shops,
Sure.
any number of places. And I always tell people, if you want to know how important your collections function is, look at it as a rescue mission, right? Because next time you're driving down the street and look at all the other people that want to work with your members that are in that lower level, check cashing, title lending, we buy ugly homes, credit doctors, bankruptcy attorneys. So we need to up our game. We need to use all the tools that are available and try to help them. Plus, it helps our bottom line, right? People
Absolutely.
forget charge-offs come right out of income, right?
The income right off your net worth, and NCUA is there with a bean counting pencil to make sure that you're still well capitalized. So, yeah, David, this has been great. Has there been any final thoughts as we wrap up today? And then beyond any final thoughts, if someone wants to get in touch with you after you give your final thoughts, give your contact information in case anybody would like to reach out and continue this dialogue.
Absolutely. So, yeah, threefold. Number one, that the collections function should not be judged primarily by charge off and delinquency, right? Because one of the other things that the NCUA pointed out in the supervisory priority letters is, and I'm trying to think of what word they used. They used one of those good regulatory speak words. They didn't say that loan growth was down or shrinking. They said it had been moderated. But simple ratio, as loan growth goes down, delinquencies and charge-offs go up because guess what? It's a ratio. We need to look at the dollars that are moving and the members that are being helped. So that's one. Number two, again, be proactive. Take a tour. Look and see how you're contacting members in all the other departments, texting, chatting, Teams meetings, whatever it is. All of those ways that everybody else in lending and card services and marketing and IT and heck, even BSA, they get our anti-money, anti-terrorist financing. They get all those good toys. We'll see if we can leverage that. And the final thing is, again, this is a great time just to kick the tires and to see how you're doing things, right? To make sure it matches not only the challenge of what's going on in the marketplace, but also meeting all the opportunities that a credit union has, again, to utilize all of those different tools.
And then if someone wants to reach out and reach you, I know I see you on LinkedIn. I've got your email and phone, but how could someone best reach you?
The best way is by far going to be by email address, which is going to be david@reedandjolly.com. That's REEDANDJOLLY.com. And or my telephone number, 703-675-9578. But his email is by far the best. Even if I'm traveling, which I do extensively, I'm able to check that a lot of times, whereas phone calls are a little bit less. I'd love to help people in any way I can. I'm passionate about credit unions, and I'd like to think that I bring value in my maybe less than routine opinions on the member solutions area.
Very good. This has been a lot of fun, and I'll put your email in my show notes. And David, I want to thank you for being here today to share your wisdom with me and with my listeners.
Great. Thanks so much for having me.
You got it. And listeners, I want to thank you for listening. As always, I hope you'll listen again soon. This is Mark Treichel signing off with Flying Colors.